So as you see here, P1 is going to deal with estimating these uncollectible accounts, just like what we've done in the previous examples. Okay? McLennan Company had an accounts receivable balance of $320,000 and a credit balance in allowance for uncollectible accounts of $16,700 at January 1st, 2014. During the year, the company recorded the following transactions. So it tells us sales on accounts, sales returns and allowances, collections from customers, and worthless accounts written off. The company's past history indicates that 2.5% of its net credit sales will not be collected. The first job is to prepare T accounts for the accounts receivable and allowance for uncollectible accounts. Enter the beginning balances and show the effects on these accounts of the items listed above, summarizing the year's activities. So the first thing we're going to do is create T accounts. Are your T accounts listed for you? So do you have accounts receivable and allowance in P1? Okay. Okay, I'll make it as big as I can. So the first thing we're going to do is with those T accounts, we're going to put in those initial balances. So P1, okay, so the first thing, accounts receivable, we should show an initial balance of $320,000, okay? How do I get rid of this screen? Just get out of there. Okay. So the first thing we'll do is show that balance of $320,000 in the accounts receivable, and in the allowance for uncollectibles, we should have a credit balance of $16,700. Okay? Then from there, we have to put this information in these T accounts. A, sales on account, $1,052,000. Sales on account mean credit sales, okay? If they said sales total, cash and credit, then that would be the total sales. But sales on account mean credit sales of $1,052,000. What are we going to do with that figure? Doesn't that increase our accounts receivable? So we will want to take that $1,052,000 under A. We're going to show credit sales a debit of $1,052,000. Okay? Then it tells us for B, sales, returns, and allowances by credit customers, $53,400. Well, that means they don't owe us that money anymore, do they? So under B, we will credit accounts receivable of $53,400. Okay? Then it says D, worthless accounts written off, $19,800. In this scenario, when we write accounts off, we are going to credit our accounts receivable to get rid of it, but we'll also debit our allowance for doubtful accounts to adjust. So as you see here, under D, write-offs, we're going to credit our $19,800, and under allowance for uncollectible accounts, we're going to debit our $19,800. That gives us a new balance in our accounts receivable of $3,058. Now, how do I get that? I start with my beginning balance of $320. I add the $1,052,000. I subtract all my credits. $53,400, $993, $19,800. I don't think I talked about collections from customers. I'm sorry. C, collections from customers during the year, $993,000. So once we receive the cash, we're done getting that accounts receivable. Okay? So by debiting our $320, debiting our credit sales of $1,052,000, then our sales, returns, and allowances, we credit because they return the goods. They don't owe us that money. Then our collections from customers, when they paid the bill, we debited cash, we credited the accounts receivable. And then the write-offs, meaning we know certain accounts, we decided to write them off, we're not going to get paid for them, credit of $19,800. This gives us a new balance in our accounts receivable of $3,058. Now, under our allowance for uncollectibles, we know we started the year with $16,700, but we wrote off $19,800, which we have to debit when we write it off. So we now have a new balance sitting in our allowance for uncollectibles of $3,100. Does that make sense with everybody? Y'all good with that? Next, number 2 says, compute uncollectible accounts expense, determine the ending balance of allowance for uncollectible accounts, and net accounts receivable under the percentage of net sales method and the accounts receivable aging method, assuming an aging of the accounts receivable shows that $24,000 may be uncollectible. So we are going to compute the journal entries under both methods. Now we know our net sales method, it tells us the company's past history indicates that 2.5% of its net credit sales will not be collected. So what are we going to do? If we know 2.5% of our sales on account of $1,052,000 will not be collected, what are we going to do there, guys? 2.5% of $1,052,000. So as you see here, $1,052,000 times 2.5%. And we have to subtract out, sorry guys, what we received back. We had credit sales of $1,052,000, but we had $53,400 that got returned to us. So our credit sales on collectibles will be on the difference. The $1,052,000 minus our returns of $53,400 times 2.5% gives us $24,965 that we are going to show to, we would do a debit to uncollectible accounts expense and a credit to our allowance for uncollectible account expense, wouldn't we? Okay? So our percent under this method, our uncollectible account expense is $24,965. Now, I think it asks us, what is our balance now in our allowance for uncollectible account? Didn't we have $3,100 as our debit going into this? See up here? We had $3,100 as a debit. So if we did an allowance for uncollectible account credit, $24,965, and then we have a debit of $3,100, what is our ending balance sitting in our allowance for uncollectibles? Wouldn't it be a credit of $21,865? Okay, let me show you how. We started with $3,100. We then created a journal entry to show $24,965, uncollectible account expense, $24,965, allowance for uncollectible, $24,965. That's a credit. So if we put that credit over here, what is our new balance? A debit of $3,100, a credit of $24,965 would give us a new credit balance of $21,865. Does that make sense? Now it asks us how to calculate what our accounts receivable is going to look like on the balance sheet. We know we have an accounts receivable balance of $3,058. Then with our new balance of the allowance of uncollectibles of $21,865, won't our new balance in accounts receivable be $283,935? The way we're getting that is our accounts receivable right now is $3,058. Okay? So if you look at a balance sheet, if you look at this balance sheet, accounts receivable of 3058 less allowance for uncollectibles of this 21,865, our net receivables would be the difference. $283,935. Does that make sense? Yes? No? Speak to me. Okay? So that's how we're coming up with our $283,935 is the net amount. Now we're going to do the aging method. Under the accounts receivable aging method, it tells us the aging of the accounts receivable shows that $24,000 may be collectible. So in this method, this number needs to be $24,000, doesn't it? Right? What is it we're going to do to get $24,000 there? If $24,000 must be here, and this is a debit of $3,100, what does our journal entry need to be? $27,100. Right? We need a debit to accounts uncollectible expense of $27,100, a credit to allowance for uncollectibles of $27,100 to get a balance of $24,000. So do you see how our uncollectible expense needs to equal $27,100, or excuse me, needs to be $24,000, but our journal entry is going to be $27,100 because our ending uncollectible accounts allowance needs to be $24,000. What will our net accounts receivable show? Well, it's still going to be this 3058, but instead of less allowance uncollectible of 21,865, it's going to be 24,000, isn't it? To have a net receivables of 281,800. 281,800. Does that make sense? Don't worry about part 3. We're not going to do any of these receivable turnovers. All we're focusing on, so don't worry about any of these percentage calculations, accounts receivable. We're not going to mess with that in this chapter. Okay? P2. It asks compute the receivables turnover and days of sales uncollected. Do not worry about that. So when you're doing P5, don't worry about that.
Just don't do it? Or?
Don't worry about anything to do with ratios. Techno Design Store uses the accounts receivable aging method to estimate uncollectible accounts. On February 1st, 2014, the balance of the accounts receivable account was a debit of $442,341, and the balance of the allowance for uncollectibles account was a credit of $43,700. During the year, the store had sales on account of $3,722,000, sales returns and allowances of $60,000, worthless accounts written off of $44,300, and collections from customers of $3,211,000. As part of the end-of-year procedures, an aging analysis of accounts receivable is prepared. The analysis, which is partially complete, follows. So this is similar to what we did in a previous example, where it gives us our total receivables, that portion that's not yet due, the amount that's 1 to 30 days old, 31 to 60 days old, 61 to 90 days old, and those over 90 days old. To finish the analysis, the following accounts need to be classified. From past experience, the company has found that the following rates are realistic for estimating uncollectible accounts. So, we know we're going to have to create that chart to figure out how much gets put into each area. So this is, as part of the end-of-year procedures, an aging analysis of accounts receivable is prepared. The analysis, which is partially complete, follows. So these dates are when they were due. If we are dealing with January 31st and J. Curtis has a due date of January 15th, where are we going to put this in? Which section is he going to go into? Is he 1 to 30 days past due? See what I'm saying? So the first thing you're going to do, I don't know what you have on your sheet. Do you have a sheet that shows Techno Design's aging service? Okay. So the first thing I want you to do is always do your title. Most important. Techno Design Store, Aging Analysis of Accounts Receivable, December 31st, 2015. And the first thing I want you to do then is put in those balance forwards, which you will see here. Balance forward, the total, the not yet due, the 1 to 30 days of 149,614, 31 to 60 days, 106,4, 61 to 90 days, 57,442, and over 90 days, 41,402. So as you can see here, let's just carry balance forward and let's put all these in here, okay? See what I'm telling you? I need more pretzels. Then it says we have to enter some additional information. J. Curtis now has a balance of $11,077 that was due January 15th. Well, this report is dated January 31st, so we're going to add in J. Curtis, add it to our total, and we need to appropriately put it in the right spot here. 1 to 30 days past due, $11,077. Okay? We're going to do the same with all of them. T. Dawson, February 15th is when his are due, which means his aren't due yet. December 20th means this one is 31 to 60 days past due. October 1st His, I think, are 61 to 90 days, or are they over 90? El Zapata, oh, I was wrong. 31 to 6, October? That doesn't make sense. El Zapata, oh, December 20th. But our COPA, October 1st, that should be past 90 days. Yeah, it is. Over 90 days past due. So what you need to do is finish this chart. You're going to add all these names, include what they, the receivables in your total, and put them in the appropriate spots here so we can calculate correctly the various amounts. Okay? Okay, so what we're going to do here is we're going to total the various total accounts receivable. The not yet due, we're going to add our T. Dawson of 93.14 plus our Rosenthal of 43.89 to come up with a new balance of 452,636 that's not yet due. Our 1 to 30 days past due will include J. Curtis and E. Land for a total balance of the 175,401. And we'll move on for the 31 to 60, 61 to 90, and over 90 days. Now, the company, from past experience, has found the following rates are realistic for estimating uncollectible accounts. So what we'll need to do is calculate the percentage based on the aging method. Compute the end-of-year balances before any adjustments of accounts receivable and allowance for uncollectible accounts. So the balance of the accounts receivable account was $442,341. So we should see here, we start with $442,341. Then it tells us that our credit sales on account, $3,722,000. So we're going to add to our beginning balance our credit sales of $3,722,000. Then it tells us that we had returns and allowances on these credit sales of $60,000. We had worthless accounts that were written off of $44,300, and we received from customers $3,211,000. $3,211,000. So as you can see here, our accounts receivable began with our $442,341 balance. We add to it our credit sales. We subtract from it our sales returns and allowances, those accounts that we've written off, and those monies we've already collected, to come up with an ending balance in our accounts receivable of $849,041. Okay? They're doing a little different method than what we do with T accounts. I'm good at visualizing the T account because I work with that. But this is the same concept. Okay? Let me know when you're ready. Now, it wants us to do the same thing to compute the balance in the allowance for uncollectible accounts. It tells us that we started a balance with a credit of $43,700. So you see our $43,700. Then the only other thing we have to do there, it said we wrote off worthless accounts of $44,300. So if we take our $43,700, subtract our accounts that were written off, we have a debit balance at the end of the year of $600. Okay? Again, if I do a T account, 43,700, 44,300. If I do a T account, a 43,700 credit and a 44,300 debit, give me what is my balance? $600 debit balance. Okay? Then we need to prepare an analysis computing the estimated uncollectible accounts. It gives us our percentages here. 2% of those not yet due are going to be uncollectible. 1 to 30 days, 5%. 31 to 60, 15. 61 to 90, 25. Over 90, 50. So, as you can see here, what we've done is we draw the numbers over from that first page. Not yet due, the 452,636. Percent considered uncollectible, 2%. Give us our allowance for uncollectible accounts just based on those not yet due. Then 1 to 30 days past due. We'll take that total that we derived from the previous page. Percent considered uncollectible of 5% gives us our allowance for uncollectible on that figure. 31 to 60 days past due, we're getting this 115,064 back from here. 115,064. 31 to 60. 115,064. 61 to 90, 63,758. See how we're getting them? Putting them in here. Taking the appropriate percent, coming up with, multiplying that total times the percent, adding all this together, where our allowance is $72,114. You guys cool? You get that?
So write-offs are debit?
What?
Write-offs are
when we write them off as an uncollectible, think of it this way. The first thing we do when we create the journal entry is we'll expense the uncollectible account expense. That's the debit. When we create this adjustment, we'll credit this allowance. But when we truly do them, write them off and get them out of the accounts receivable, an accounts receivable normally has a debit balance. To get them out of accounts receivable, we'll credit it. Just like when you pay for something, you know, when the client pays, you credit it. So if we credit accounts receivable, we're going to debit our allowance because we're basically reducing that allowance we've reserved. We have so much in our allowance that we're saying will get written off. As we write them off, we debit it to reduce that balance sitting out there. A normal allowance for doubtful accounts or uncollectibles is a credit balance. So as we write it off on accounts receivable, we're going to credit our accounts receivable, we'll debit our allowance. Because our allowance allows for us to write off those accounts, but since we've already expensed them in a previous period, when we write off those accounts, we debit our allowance. Okay? Now it asks us, in number 4, how much is Techno Design Store's estimated uncollectible account expense for the year? Remember, we want our balance to be $42,114. But if we already have a debit $72,114, but if we already have a debit balance of $600, what does our journal entry need to be to create our desired balance of $72,114? Let's look back at it here. If we know we want this to be $72,114, and what were the figures? A $600 debit. Then what do we need this to be? $72,714. Does that make sense? So we're going to need the journal entry to be $72,714. So we end up with the balance we want. Okay? We're not going to worry about interest on notes. You're going to get to it many other times. I'd rather focus on what this is the key that matters right here. P5, I want you to go through. It's just like, very similar to the other account problems we've just gone through. Don't worry about part 3 of P5. And P6 is just like what we've gone through here. I'm going to send you on Excel the I'm going to send you Excel templates so you can do these problems for those that have it. Otherwise, you'll just have to set it up like
on notebook paper, you're saying?
Whatever you want to do. Notebook paper, if you want to do it online through Excel, you can do that. Any questions before we end this? Are you guys